There is a photograph taken in Mayfair in the spring of 2016, a terrace of Georgian townhouses, each one worth more than most people will earn in 5 lifetimes, their white stucco facades, glowing in the kind of weak English morning light that painters have tried to capture for 300 years and never quite managed. Sold signs outside 3 of them. A fourth being converted, scaffolded, gutted. The street itself almost entirely quiet on a Tuesday morning. Not the quiet of a working neighborhood before it wakes up, but the quiet of a place that does not need to wake up because nobody is required to be there. Wealth so concentrated and so absent simultaneously that the street functioned less like a neighborhood and more like a storage facility for money that had somewhere better to be. That image was called a sign of London's success. The prime property market was booming, they said. Global capital was choosing London. The city was the undisputed financial capital of the world, and the numbers proved it. Now look at the same postcodes in recent years. Luxury developments standing at 30, 40, 50% occupancy. Prime central London property values that have declined in real terms every year since 2016, while every other major asset class globally has risen. The hedge funds that defined Mayfair for 2 decades quietly relocating their registered entities to Dublin, Amsterdam, Singapore, and the bankers who ran them following with a speed and a silence that the financial press, which depends on those bankers for access and advertising, has been remarkably reluctant to describe honestly. The official story is that London remains the world's greatest city, a global hub, resilient, adaptive. The numbers are complicated, they say, but the fundamentals are sound. That is not what the data actually shows. And what is replacing the people and capital who have quietly left, or rather what is not replacing them, tells a story that goes far beyond property prices and passport applications. This is the story of a city that spent a century and a half monetizing its own imperial mythology until the mythology became the only product left. A city that confused being the world's financial capital with deserving to remain the world's financial capital, and a city that is now discovering, slowly and without any single dramatic moment that anyone will be able to point to and say there, that was when it ended, that the two things were never the same. If you have been watching cities like London carefully, watching what happens when global capitals lose the structural advantages that made them capitals in the first place, you already sense that something is wrong. Not wrong in the way that tabloids mean when they run crime statistics. Wrong in the deeper way. The way that cities go wrong before anyone admits it. Subscribe. Empire Falls documents the structural decline that institutions with a financial stake in the comfortable story cannot afford to cover honestly. London has been accumulating the conditions for this moment for far longer than most people realize. The problem, as with all cities that decline magnificently, is that it has always looked extraordinary while the foundations were shifting, which made diagnosis almost impossible until the shift had already become irreversible. You cannot see the rot beneath the gold leaf of Canary Wharf. You cannot hear the structural failure beneath the sound of a city that still hosts more billionaires than any other in Europe. The numbers are clinical and worth stating plainly. Between 2017 and 2023, the United Kingdom lost more non-domiciled high-net-worth residents than any comparable period in its modern history. In 2023 alone, an estimated 200 millionaires left the UK, the second highest net outflow of wealthy individuals of any country on earth that year, behind only China. The top 10% of income earners, who contribute approximately 60% of all income tax receipts, have been leaving at a rate that the Office for Budget Responsibility has begun, including in its long-term fiscal projections, not as a risk scenario, but as a baseline assumption. This is not a spike, it is a trend, and the trend has direction. But the departure of the wealthy is not the story. It is the symptom. The story is what drove them out and what that mechanism is doing to every other layer of the city below them, because the wealthy left first simply because they had the resources to leave first. The middle class has been following more slowly, less visibly, and in ways that the official statistics are poorly designed to capture. Young professionals who once moved to London as a matter of course, who treated it as the only serious option for a certain kind of career in finance, media, law, technology, are choosing Berlin, Amsterdam, Lisbon, Dubai instead, not because those cities are as good as London was, but because London is no longer good enough to justify what London now costs. The city is losing approximately 100 zero residents per year on net to internal migration within the UK alone, people leaving London for somewhere that still functions as a place rather than a monument to what a place used to be. The infrastructure of a global capital without the population that made it one. What makes this more than a demographic footnote is what it reveals about London's claim to its own identity, because London has not simply been a city of finance and culture. It has been, for the better part of 2 centuries, a city that attracted people in the act of becoming. Young lawyers becoming senior partners, young traders becoming fund managers, young artists becoming the people who defined what British culture meant to the rest of the world. That process of becoming required London to be a place where becoming was possible, where the cost of entry was high but not prohibitive, where the reward for success was the city itself, its density, its access, its irreplaceable social infrastructure of institutions and connections and proximity that you could not replicate anywhere else. That London is disappearing. Not dramatically, gradually. One professional who chose Dubai over Canary Wharf, one artist who chose Berlin over Hackney, one family that chose Edinburgh over Clapham, because Edinburgh now offers 90% of what London offers at 60% of the cost, and none of the commuting infrastructure that stopped working 3 years ago and never quite recovered. The financial story accelerated this erosion faster than almost any other single factor in modern British economic history, and it began not with a crash, but with a vote. The Brexit referendum of 2016 did not simply change Britain's relationship with the European Union. It changed London's relationship with its own competitive advantage. London's position as the world's preeminent financial center had rested, since the creation of the single market, on a specific structural fact that a bank or fund or trading house headquartered in London had automatic legal access to 450 million European customers without a separate regulatory structure in each jurisdiction. Passporting, it was called, and when passporting ended, the migration of financial entities that followed was not a statement about politics. It was arithmetic. By 2022, Dublin had become the single most popular destination for financial firms relocating European operations from London. Frankfurt had absorbed a substantial portion of the derivatives clearing business that had defined London's position in global currency markets. Amsterdam had become the largest share trading center in Europe by volume, a title London had held without serious challenge for the better part of 3 decades. These were not announcements. They were regulatory filings, quarterly reports, LinkedIn updates from managing directors whose new office addresses told the story that no press release was going to tell. The city noticed. There were government task forces and investment summits and speeches about global Britain. None of them addressed the structural problem because the structural problem required an admission that the government that created it was constitutionally unable to make. The removal of passporting was unthinkable before 2016. After 2016, reversing it was politically impossible. London was trapped, precisely as Venice had been trapped, between a problem it could name and a solution it could not choose. But here is where it gets more unsettling, because the financial exodus is not even the deepest layer of what is happening. Beneath the departure of the hedge funds and the relocation of the clearinghouses, something slower and more fundamental has been shifting. London became the world's financial capital not simply because of geography or history or regulatory convenience. It became the world's financial capital because it was, for a specific period in a specific configuration of global circumstances, the best place on earth to be the kind of person who was good at making money move. The talent concentrated there because the talent wanted to be where the other talent was. The institutions grew there because the institutions needed to be near the talent. The infrastructure, legal, educational, cultural, social, built itself around the talent and the institutions and became, over generations, self-reinforcing. That self-reinforcing system requires one thing above all others to sustain itself. It requires that the best people, when choosing where to build a career, choose London. And they are choosing it less, not dramatically, in the margins. But in a competition that operates at the margins are everything. The testimony coming from practitioners inside the system is consistent. And when people speak honestly, rather than for the compliance record, remarkably direct. a senior partner at a mid-size asset management firm who spent 20 years building a practice in the city, described the decision to relocate his European client operations to Luxembourg in 2021 in terms that were difficult to argue with. The problem, he said, is not that London has become bad. The problem is that London has stopped being obviously better when you are paying 3 times the rent, twice the tax, and navigating a regulatory environment that has become genuinely more complicated for cross-border work. You need London to be offering something that compensates for all of that. It used to. It does not now, not clearly enough. And once that calculation tips, it tips fast. Because everyone in this industry is watching everyone else make the same calculation. The data that emerged from the post-Brexit adjustment period is instructive in ways the government found uncomfortable. Financial services employment in London peaked in 2019 at approximately 400,000 jobs. By 2023, it had declined by roughly 35,000 positions, with projections suggesting a further decline of similar magnitude through 2027. The average compensation in London's financial sector, which had remained one of the most powerful arguments for the city's continued attractiveness as a destination for global talent, grew at roughly half the rate of comparable roles in New York and Singapore over the same period. And the category of worker that every city needs most to sustain a financial center, the experienced mid-career professional, mobile enough to choose, senior enough to matter, was choosing other cities at rates not seen since the period before London's Big Bang deregulation in 1986 that had created the modern city of London in the first place. The history of London as a global financial capital is shorter than most people imagine, and understanding it is essential to understanding what is happening now. The City of London's position as the world's preeminent financial center was not ancient. It was constructed, in its modern form, across a relatively compressed period beginning in the late 19th century and reaching its apex in the decade after the 1986 deregulation that opened British financial markets to global capital. Before that, London's financial power rested not on technical sophistication, but on imperial positioning. The city sat at the center of an empire that controlled a quarter of the world's land surface, and financial services flowed through London because trade and governance flowed through London, not because London had built something that could not be built elsewhere. When the empire contracted, London spent 4 decades in a kind of prolonged institutional twilight, maintaining its forms and its ceremonies and its claim to preeminence while its actual commercial position quietly shifted. The Big Bang of 1986 was not a rebirth. It was a reconfiguration, a decision to replace imperial positioning with regulatory attractiveness, to become the city that global capital chose freely rather than the city it was directed to by force. That reconfiguration worked brilliantly for 30 years. It worked because it was built on a genuine competitive advantage, a regulatory environment that was sophisticated without being punitive, a legal system that global capital trusted, a time zone that sat between New York and Asia, a language that global finance had already chosen, and a talent pool that 4 decades of being the destination had accumulated. Brexit removed one of those advantages in a single referendum. The cost of living crisis eroded a second. The tax changes of 2024, the abolition of the non-domicile regime that had allowed wealthy foreign nationals to shelter overseas income from UK taxation, removed a third. 3 of the 5 structural advantages that had sustained London's position gone inside a decade. What Rome faced when the Mediterranean trade routes that had sustained its economy were disrupted in the 3rd century, London faces now. What the Dutch Republic faced when the financial center of gravity shifted from Amsterdam to London in the 18th century, the successor cities to London's dominance are beginning to sense as an opportunity. The pattern is not new. What is new is the speed at which it is operating and the degree to which the official apparatus of British financial boosterism is constitutionally unable to describe what is happening at the pace at which it needs to be described. Here is the counterintuitive conclusion that the official story cannot accommodate. London is not declining because it failed. London is declining because it succeeded so completely and for so long that it confused the success with permanence. The city did not lose its competitive advantages through negligence or mismanagement, though there has been both. it lost them through a combination of its own political choices and the normal operation of a global economy that does not grant permanent monopolies to anyone, regardless of history. The financial capital of the world in 1950 was London. In 1980, it was New York. In 2000, it was both, plus emerging competition. In 2024, the answer is genuinely unclear for the first time in living memory. That unclarity, after 150 years of London being the obvious answer, is the data point that nobody in the official narrative has been willing to state directly. And what comes next is the question that the investment summits and the Global Britain speeches are not designed to answer honestly. The projections are not secret. On current trajectories, London's share of global foreign exchange trading, which stood at 43% in 2019, will fall below 35% before the end of the decade. The financial sector's contribution to UK tax receipts, which has funded the public services that make London function as a city for its non-wealthy majority, faces a structural gap that no government has yet presented a credible plan to fill. The international students who once chose London's universities as the automatic destination for a certain kind of postgraduate education, and who provided both revenue and the next generation of talent that would stay, are now distributed across a wider set of destinations in ways that look from the inside of the university system like the beginning of a structural shift rather than a temporary fluctuation. The choice London now faces is one it has not faced in its modern form and cannot entirely control. It can attempt to reconstruct the conditions that made it the world's financial capital, which would require political decisions that the current political settlement makes extraordinarily difficult to reach. Or it can accept that its role in the global economy is changing and invest in becoming something different, a city of culture, of education, of tourism, of creative industries, extraordinarily rich in accumulated human capital, but no longer the automatic first choice for the kind of mobile global capital that made it extraordinary in the first place. The irony, and it is the kind of irony that cities in late stage transitions specialize in generating, is that the second path might be commercially sustainable. Some of the world's most livable cities are not the world's most powerful ones. Vienna is not Frankfurt, Barcelona is not Madrid, Lisbon is not London. A city can be magnificent and diminished simultaneously. It can be worth living in and worth visiting and worth loving and still not be what it was. But the people who built their careers and their identities on London being the first choice, the automatic choice, the only serious choice for a certain kind of ambition, they are finding that the adjustment required of them is not one they were prepared to make, and they are leaving before the adjustment becomes necessary. The residents who remain in London know this without needing to be told. You do not need to have a long conversation with a professional in their late 30s living in zones 2 or 3, watching the cost of a flat they could have bought in 2010 now sit permanently beyond reach, watching the company they work for conduct its third restructuring in 4 years as it reconfigures for a post-Brexit, post-cheap money reality, watching the public services that were the invisible subsidy of London life in its confident years quietly deteriorate. You do not need that conversation to understand that something has changed in the city's relationship with the people who are supposed to be its future. They are not bitter, most of them. Bitterness requires surprise, and nobody who has been paying attention in London has been surprised by any of this for a long time. What they have is something closer to a recalculation, a quiet reassessment of whether the city is offering them what it was always supposed to offer. The sense that being here, enduring the costs, accepting the compromises, was being repaid in opportunity and access and proximity to something that mattered. And for a growing number, the recalculation is not resolving in London's favor. The outside world, meanwhile, is beginning to sense what the capital flow data has been showing for several years. London is no longer reliably delivering the proposition it advertises. Not because the city has lost its beauty or its culture or its extraordinary accumulated density of institutions. The British Museum has not moved, the Tate Modern has not deteriorated. The legal system remains one of the most trusted in the world for international commercial disputes, and that trust, built over centuries, does not evaporate in a decade. These things have not changed and will not change quickly. What has changed is the frame around them, the living city of ambition and arrival and becoming that gave the institutions their meaning. Strip away the city of becoming, and what remains is a city of heritage. Magnificent, irreplaceable, worth visiting, worth studying. But a city of heritage alone does not justify the salary sacrifice and the housing cost and the infrastructure frustration that London still demands. And once the sophisticated observer, the investor, the professional, the institution making its 10-year location decision, once they make that distinction, the spell breaks. And once the spell breaks, it is very difficult to restore. This is the moment London is in. Not collapse, not crisis in the emergency sense. No single event that historians will mark as the turning point, just the slow accumulation of recalculations. The fund manager who files in Dublin, the tech company that registers its EU entity in Amsterdam, the young professional who takes the job in Zurich and discovers, to their own mild surprise, that they do not miss London the way they expected to. The restaurant that was genuinely excellent and then stopped being excellent because the chef moved somewhere that the economics made sense. The school that was exceptional and then started losing teachers to better funded systems in Scotland and Canada and Australia because London's public sector pay had stopped competing with London's private sector cost of living. Empires do not fall in a day, they fall in calculations. Thousands of individual calculations, each one rational in isolation, each one adding its small weight to a balance that is, slowly and without drama, tipping. Tell us in the comments which city you think follows London, the one that still looks permanent, the one that mistakes its history for its future, the one that is, right now, making the same category of error that London made when it confused being chosen with being unchallengeable. Empire Falls is already looking at it, and the pattern, as always, was visible long before the fall. Empires do not fall in a day. They fall in calculations.